individual markets, you get, rather than the individual agents of an economy. Okay, so that is that about the definition of macroeconomics. That's what macroeconomics entails. It deals with the behavior. It studies the behavior of an economy. Okay, and the overall performance of an economy. Okay, so that now brings me to the objectives. Okay, the objectives of macroeconomics are basically we we have um we have about five most common objective. Okay, and then number one thing we aim to achieve when studying macroeconomics is to achieve economic growth. Of course, it is every country's desire to grow their economy. Okay, it is every country's desire to grow their economy. So why do we study economics? What is the objective of studying macroeconomics? It is simply to achieve economic growth. Okay, simply to achieve economic growth. And then another objective is to achieve price stability. Okay, to achieve price stability. So you might be wondering, okay, what does price stability really, I mean, how's that really important? Okay, so price stability is an important goal, for the economy. It's an important goal in macroeconomics because the price of things should be stable. Why should the price of things be stable? It's when prices change, it can affect your future decision. I mean, your plans. For example, you might be planning to carry out an activity maybe in the next 4 months, and then you are uncertain because of price instability. You are uncertain. You don't know if the price would have scaled up or not. Okay, but when there is price stability, it gives room for proper budgeting. It gives room for proper planning, proper economic planning. Okay, so when there is no price stability, there won't be proper economic planning. In the process of planning an economy, there's always a budget. Okay, there's always a budget. That's usually why sometimes when governments approves, or when they approve a particular budget, you see that it's in the long run becomes deficit. Okay, that's as a result of price instability. Okay, maybe if right now you are buying something 100 naira, and then the next few months it has scaled up times five. How would that, I mean, the effect of that would be that your budget would run into deficit because there's no enough provision to cushion the effect of price instability. Okay, so another objective of macroeconomics. It is to you know um, it is to achieve price stability. And then another one is to reduce unemployment, or to achieve full employment. Okay, it is every country's desire to achieve full employment, even though the Keynesian um, school of thought does not believe in full employment. Okay, but the objective of macroeconomics is to achieve you know full employment, or reduce unemployment to the minimal level. Okay, and then another one is to please, this point it might come out in exam. Okay, so don't underestimate all these little things. It might be part of the sub questions um that will be brought in the exam. Okay, so another objective is to achieve favorable balance of payments. So when we talk about balance of payments, okay, it has to do with the economic trading. Okay, the economy, I mean, when a country trades with, it's a function of the international trade that takes place in the country. Okay, so we have different kinds. We have favorable and unfavorable balance of payments. Okay, when a balance of payment is unfavorable, it means that we are importing more we are spending more on imports than we are getting from the exports. Okay, that is not favorable. It is every country's desire to be to be self-reliant, okay, and not to be too dependent on other countries' resources. Okay, so when we are too dependent on other countries' resources, we tend to import more, and then the effect of that is is that we fall into unfavorable balance of payments. Okay, that's when your import is greater than your export. So the one of the objectives of macroeconomics is to achieve favorable balance of payment. That is, when production is high in a country and then we produce more goods, there's tendency of us even exporting part of the domestically made products, thereby increasing our national income. Okay, so when there is more exports, then it is favorable. The effect on our GDP is positive. Okay, that means we are getting some earnings from exports. Okay, and then lastly, it is this even distribution of income. Okay, even distribution of income. There's this circular flow of income. In this kind of economy, or in any economy, the importance of distribution of income should not be overemphasized. Okay, because there must be government in place to regulate things. We are all rational beings. Rich people would want to get richer, okay, thereby exploiting the less privileged ones. Okay, so that's where government comes in, and then they introduce their fiscal policies and all. Okay, their taxes, trying to get from here so they can produce. Give public goods, or set up some kind of factories that can empower other less privileged ones and all. Okay, so those are the um, objectives of macroeconomics. Okay, I will go through it again. Number one objective is to achieve economic growth. Please, if you forget anything, don't forget economic growth. But of course, these are simple to memorize. Okay, achieve economic growth, maintain price stability, reduce unemployment level, attain favorable balance of payments, and then even distribution of income. Okay, those are the objectives of macroeconomics. Okay, so that's by the way. Now, nevertheless, there are some theories. There are theories of macroeconomics. Okay, and there are different ideology of these theories. Okay, I'm sure we've all heard about Keynesian theory. Keynesian theory, and then the classical macroeconomic theories. Okay, you'll be wondering who's macro. Who's classical? Who is Keynesian? Okay, so classical school of thought, I believe, is pioneered by, you know, I think Adam Smith, if I'm not wrong. Okay, and then the Keynesian is this John Maynard Keynes. Okay, that's J.M. Keynes. Okay, so they have different ideologies about how an economy should operate. Okay, nevertheless, to an extent, they might be right. Okay, to an extent, they might be right. They all have their own what's it called? They all have their advantages. Their strengths and weaknesses. Okay, so we have majorly the key macroeconomic theories that we have are the classical macroeconomic theory and then the Keynesian macroeconomic theory. You might be asked, okay, you might be asked to discuss the different macroeconomic theories we have, their ideologies. I think the man treated it in class. Okay, he treated the different ideological perspectives of these microeconomic theories, okay, which are the classical and the Keynesian. I wish I can type, but then, I told you economics is a fusion of literature and calculation. Okay, I man tojo at the man calculate. Sorry for those who does not understand Yoruba. We do more of explanation. We explain, we write, we do more of writing, and also do calculation too, and also even graph. So geometry, mathematics, and literature, all in one subject. Okay, so that's by the way. Now, this macro, please just be attentive. Like I said, open your mind and flow with me. Okay, open your mind and flow with me. And please, if you have any question in between, please do not hesitate to ask so we can deliberate on it, even if I don't know it. Okay. So macroeconomic theories. What are these theories about? Like I said, there is no perfect theory. Okay. They all have their strengths and weaknesses. In one way or the other, they are correct. You get, in one way or the other, they have their reasons for coming up with that theory. Okay. But it is now in your own place to understand what these two theories are talking about and then make your choice. Oh, okay. Keynesian theory says this. Is this true? Classical theory says this. Is this true? Okay. So these theories, they provide different perspectives on how an economy should function. Okay. They determine, they deliberate on how would an economy achieve economic growth. You get, how will economies achieve all these macroeconomic theories? Okay, so they have their own ways. They have different ways of achieving their, macroeconomic objectives, which are economic growth, price stability, reduction in unemployment level, and then favorable balance of payment. All these, okay, they have different ways. Okay, so they have different perspectives of how economies function and what really drives, economic growth, employment, and stability. Okay. Nevertheless, I said each theory has its own strength and weaknesses. Okay. So it is now in our place. Why are we even studying macroeconomics? It is to use the knowledge to, it's basically applying the knowledge of macroeconomics to come up with some policies, workable policies that can, provide solutions to some economic issues. Okay, so it is in our place to study these two theories, these two school of thoughts very well, and then draw from their strengths, and then, learn from their weaknesses, so we can make our own theories that can provide solution. Make our own policies that can provide solution to any economic policy. Any economic problem we are facing at a particular point in time. Okay, so each of these theory has its strengths and weaknesses, and then it is in our place to often draw, from these theories so as to address some economic issues. Now, basically, what are these theories saying? I remember the lecturer broke it down into three areas. Okay, he talked about the time horizon. He talked about the question of full employment. He talked about the role of the markets and the government in the economy. Okay, so these are the assertions of um, classical school of thought. Okay, so the classical school of thought, they believe that, the market should be left, should be left alone in the hands of the forces of demand and supply. Okay, how do I put it? Meaning that The classical theory believes that market can run itself without the intervention of government. These are the classical, I mean, these
Solomon,
are
can
what
you
the
please move
classical.
the slide up? Or is it from just
Oh,
from my side?
okay, okay. So the reason I'm not moving it up is because um, this is another topic entirely, like national income accounting. So I'm just trying to, or maybe I should just type this. Okay, let me
Oh,
update
No,
this.
type,
no,
but
don't
we
type.
shall one
Just keep
type.
explaining. Anything, no, anything is explaining. If you are following your class notes, it's aligning with the class notes. So the way it's explaining, just check your class notes.
I don't
Is
even have notes. That's the worst part of it.
because if you keep typing, it has just about 20 minutes left on this introduction before you
Let
move
me
on to the
spell
next
I
my
don't
topic.
want him.
notes.
I don't
Other
want him
I
to
will
type
spell
too.
my notes. Let me spell
Okay,
my
just keep
notes.
continue. Solomon, keep you are
Yes,
Solomon
sir.
is selling notes. I hope you will not use it to buy a calculator. Okay, let's just continue. Solomon, finish up.
Kazeem Lenue.
That's below the bed.
Kazeem Lenue.
Okay, okay. So
Calculator be
I
like
don't know if I'm
calculator
too
alone.
fast. I don't know if I'm too fast or slow, but then I want the
No, continue like this. I'm just telling you that you have 20 minutes. You have about 20 minutes left to wrap up on this introduction before we move on to the
on
next
this
topic.
introduction,
That's what I'm
right?
telling you.
We go wrap up soon. We go wrap up soon. Okay, and then we'll move to national income accounting
Let
direct.
me please
All
give me
right.
notes. Let me have something to read though, please.
I will spell my notes to
Continues.
you.
Okay, okay. So
Thank you.
the classical school of thought, okay, the classical school of thought, they believe that the economy should be left alone to be run by the forces of demand and supply. They don't believe government should intervene in the economic activities, meaning that if you are to write out, okay, don't let me jump, okay, they are secluding the government out of the economy. Okay, don't want government to intervene in anything. Leave people alone, let them decide. Okay, let them decide the price, let them decide the interest rates, let them it is the so there's what we call forces of demand and supply. It's a force. Okay, we all know that when demand is high, what happens to the price? The price increases. Okay, because high demand might lead to scarcity of that particular commodity, and then the available ones will now be very costly in the market. You get, so that's just so the classical school of thought, the classical macroeconomic theory believes that the market should, run itself without government intervention. Okay, that's the role, that's the aspect of the role and the role of government and the market in the economy. So classical school of thought believes that the market forces should run the economy. When I say market forces, I mean demand and supply forces should determine the prices, the interest rates, the anything, okay, should run the economy without government intervention. Nevertheless, Keynesian school of thought, the Keynesian macroeconomic theory says no, no, you can't say government should not intervene. Why? Because there might be exploitation. Okay, producers might be exploiting consumers. There might be, they will hike their prices and or maybe hot goods, hot or stuff like that. Now, Keynesian school of thought are saying government should intervene. Why should government intervene? It is so that there will be measures, there will be regulations, everything will be regulated. Okay, now let's take for example what's happening in Nigeria right now. Okay, whatever is happening in the oil and gas sector right now is still being regulated by the government. If you are to leave it in the hands of demand and supply, all these fuel marketers, they might be selling their petrol, I mean their own petrol 5,000 naira per liter. And that's when you see another person too say, me, I'm selling my own 10,000 naira per liter. But the essence of government intervention is to put this boundary, this regulation. Okay, this is the this is the the threshold. Okay, you can't go beyond this price. Like it's I don't know. Like that's just what government intervention. That's the importance of government intervention in the economy. It is to put things in order because we are humans. We are rational. We are okay. I won't say we are greedy, but then we do what what is best for us. Okay, and then it might lead to some kind of market failure. Okay, so Keynesian school of thought is countering what classical school of thought is saying. Classical macroeconomic theory says that there should be no government intervention. Okay, the economy should be determined by the market forces. That's the forces of demand and supply. Okay, but Keynesian school of thought. That's the Keynesian macroeconomic theory. They say there should be government intervention. Okay, there should be government intervention. Why? So as to put regulations in place to avoid, you know, um, some kind of exploitation. Okay, now that is in the aspect of the role of the government and the market. So in classical theory, the role of the government is not needed. It's just the market that determines the running of the economy. But in Keynesian school of thought, they say government has a role to play. Okay, that's government policies. They should bring up policies to regulate things. Okay, so if you two just come to think of it, if you have to think of it, me, I will go with Keynesian because you know I will go with Keynesian school of thought because most of the assertions are making sense. All those classical school of thoughts, I don't know, they don't get sense. But anyway, yes, Losha, you get.
In fact,
So
let me add some. In fact, what Tinubu is doing now is Tinubu is trying to Tinubu and Cardoso, they are trying to use the concept of classical school of thought. That is exactly why we are where we are now. For example,
exactly,
they decided to float the naira, allowing demand and
yes,
supplies to regulate naira. See where we are now. Same thing. They
yeah,
remove fuel subsidy. They don't want government intervention again on fuel. Let all of
mm,
us keep buying our fuel at the market price. See where we have landed
yeah,
ourselves now. So I think
mm,
that's one of the BBM is racist, and if you want to speak, you can speak. So I think the major problem we have now is classic that is causing serious problem for us in Nigeria. Unlike the
exactly,
previous administration where it was more of Keynesians, where government intervention. There is nowhere in the world that government does not intervene. Government have to
yeah,
subsidize something for the citizen. That is how it should be done. Unlike now that
yeah,
we find ourselves in a very big trouble in Nigeria. Okay, carry
mm-hmm.
on, bro. So I think now we
All
are
right, thank
relating it
you.
to what is happening now.
Yes, thank you for that, Casey. Thank you. So I believe you can all relate to what is being discussed in the BBM. I don't know. Does BBM wants to? Because I know BBM does some economic analysis too.
No, no, no. It's
BBM,
fine.
Shema move.
It's fine. Just that I don't fully agree that the current administration they are trying to follow classical because even though they float the economy and they remove subsidy and all, it doesn't still remove government from the aspect of regulation. They still regulate it. Just that I
Mm,
mean they analyze it a little bit to allow a bit flow of classical so as not to allow you to be fully Keynesian. So in a way, they still regulate it even with the subsidy that they've removed, they are still telling Dangote how much fuel should still be sold. So meaning that the part of regulation they are still actively involved, just that they just reduce their involvement in a way, and of course still allow demand and supply to set some things and everything and all. So that's it.
okay,
Yeah,
okay,
yeah.
thank you.
It was because their view on the classical, it was because it backfired, right? That was when Cardoso or Cardi or what they call that man, started pumping money from our external reserve to fight dollar. There was a time that it was defending dollar with external reserve. When the alarm blew, right, the external reserve got depleted. That was why the man quickly stopped. When it's then Naira was about 1,009, it dropped to 1,000 Naira. because he was using external reserve to defend the naira. So when the things started, when people started saying that the external reserve is going down, the man stopped. Guess what happened again? Naira is back to 1,006 now. So I hope he will go and look for external reserve again to be defending it. I think they are just anyway. Don't let us go politics, right? So, but I think they started with more of classical.
I can't agree
now
more.
they are trying to reverse to Keynesian, which I think is too late. Are they going to bring fuel back to 200 naira? Are they going to bring it back to 180? Are they going to bring naira back to 450? How they met it? I think it's too late. But let's continue so that we don't turn it to political platform.
Yeah, thank you. This is now looking like the big issue, like all these journalists hangouts. But then okay, so let's move on. Yes, sir.
Is it correct to call the classicals to call them capitalists?
Exactly. So I was going to make that point. We have different economic systems. We have the socialism, the capitalism, and the mixed. So I can't agree more with what BBM said about not leaving the market entirely to the market forces, because there's still a form of regulation. But I feel like the Nigerian government they are allowing the classical theory to thrive more than the Keynesian theory. Okay, so Nigeria is a mixed economy, okay, whereby the market forces also thrive, or it thrives, and also there's still the presence of government involvement in the economy. Okay, so Nigeria is a mixed economy. So I can say classicalists are more of capitalists. All these classical school of thought, they are more of capitalists. Like they don't, socialism is when the means of or factors of production are being controlled entirely by the government. Meanwhile, for classicalists, it is controlled entirely by the producers, business owners and all. Okay, but for Nigeria, it is a mixed economy. The two, just that Nigeria is allowing the capitalists thrive more in the country. So that's by the way. That's by the way. Thank you. And I'm glad we are relating this to real life issue, because it will help us understand these theories better. So when you come across it, you should be able to, make your point known. Okay. So that's by the way on the classical and also for what's it called, for the aspect of full employment that I mentioned. One of the objectives of macroeconomics is to reduce unemployment level. Okay, nevertheless, capitalists, I say capitalists, the classical school of thought, they believe in full employment. That is when they allow the market to when they allow the market forces to interact. They believe that the economy will sort out. The economy will sort out itself. Okay, the economy will sort out. Don't involve government. Governments should not intervene in trying to, like, the demand side and the supply side will find a balance. Okay, and then with that they will be able to achieve what's it called, full employment. Nevertheless, this what's it called, the Keynesian school of thought, the Keynesian school of thought, they do not believe in um full they do not believe in full employment. Okay, so they feel like there will still be an iota of structural unemployment. Okay, meaning that when there is this differences, of course it is relatable now, there is difference in skills, the skill level. Okay, for example, in Nigeria now, we can say that, I don't know shall, but the rate of illiteracy is quite high, so you don't expect that everybody will be doing well, will be employed. There are some people who are law school. I don't know, how do they want to compete in an economy? It is unreal for classical school of thought to say that there will be full employment in the long run. Like in the long run, the market will sort itself. There will be full employment. Everybody will be working. No, but Keynesians are saying there will still be structural unemployment. Why? Because the skill sets needed in the job market not everybody will possess those skill sets. For example, look at what's happening now. Most people most people they do Yahoo. You get I don't know. I'm even scared for Nigeria. Who will be in charge of these administrative offices in the long run? You get Talomashe, Minister of Abi CFO Funwa. When people are dropping out of school, they are doing Yahoo now. Yeah, if when the likes of Sadiran, BBM, when they don't grow old, when they don't retire, who on the analyze our economy like this? As everybody don't they do Yahoo. Okay, so that's the assertion of Keynesian school of thought that full employment cannot be attained. Let's be realistic. Okay, so that's by the way on that. Okay, okay, I think I have 8 minutes more to round up this particular topic, and then I move to national income accounting. So, uh, following the flow of class, or better still, let me just discuss, some key concepts,
Okay,
of
Solomon.
macroeconomics. Yes,
Solomon,
sir. Yes, sir.
can I just quickly? This is what you have just covered, and I think we should watch out for it in the exam. So I want to just use 30 seconds to summarize the key points so everybody can take notes. Since the class is being recorded, they can always refer back to it. So you said under the classical school of thought, economy should be controlled by the forces of demand and supply. Number
Yes,
one
sir.
point. Number two point is that there should be minimal role or intervention of government. They should allow things
Mm.
to flow naturally. Then
Yeah.
number 3 point under classical, all prices are flexible, right? They
Yeah.
assume that no prices is fixed. Everything is flexible. They're like wages and code, they are flexible.
Yes.
Okay. Then number 4 is that they believe that there is full employment, and if there is any unemployment, it is temporary and will surely adjust itself. So those are the 4 key points that I captured for classical. Okay, then
Yes, sir.
for Keynesian theory, here says that government intervention is required for proper regulation, that things shouldn't be left in the hands of the masses. Government should always get involved. Then,
Mm-hmm.
okay, there is active regulation of government. Government should regulate everything. Then here, under Keynesian, prices are fixed in the short run, like your wages are always fixed. They are not flexible.
Yes. Yes.
Okay, they believe
That's
that the wages should
sticky
be
price
fixed.
and
And
wages.
yeah, so the last one is that they believe that there is no full employment because of structural unemployment. So, like you rightly said, so there are some key areas that I would like you to touch before you quickly wrap up this macroeconomics. I'm trying to follow the flow of class. So, to be nice, if you can touch stock and flow concept, just take note of
Okay.
that. Stock,
Okay.
stock and flow, right? What is stock? What is flow? Quickly touch that for us.
Okay.
Then explain the meaning of statics, right? So when something is statics, quickly. I think that's just all. Stock and flow, statics. So the rest, you explain the rest under the national income. If you can use 5 minutes to explain what is stock and what is flow and what is statics, then we'll wrap
Okay.
up this
Okay.
introduction. Over to you.
All right. All right. All right. Thank you. Thank you. Okay. So, following the flow of class, the lecturer's class, um, he discussed the categorization of some variables in economics. Okay, so in economics, variables can be categorized as either stock or flow variables. Okay, and would try to find the distinction between, understand the distinction between these two types of variables. Okay, so basically, those are the two types of variables: the stock variables and the flow variables. So when we are talking about the stock variables, stock variables represent, you know, um, a kind of measurement or quantity measured at a specific point in time. It is a concept of at a point in time. Like, for example, example of that is, okay, what is the debt of Nigeria? What's the total debt of Nigeria at a point in time? Okay, for example, what's the total debt of Nigeria in year 2023? That is a typical example of, stock variable. That is, a concept that is measured at a point in time. There's a particular time. Okay, there's a particular time. Oh, what's it called? What is the capital stock? Okay, that is, what's the capital stock of a company? That is the assets of a company, the assets declaration of a company at a point in time. Okay, what is the financial position of a firm at a point in time? Those are stock variables. Okay, meanwhile, flow variable, as the name implies, flow. When something flows, it means it goes from a particular period to whenever. Okay, that is, it measures the quantity of something, or it measures a value over a period of time. Okay, so basically, don't let me ṣàlàyé too much. Stock variable is at a point in time concept. Okay, it is at a point in time concept. It measures something at a point in time. Okay, meanwhile, flow variables, this one measures something over a period of time. It measures a particular thing over a period of time. That is over time. Flow. Okay, so stock variable is a given variable for a particular period. Flow variable is a given variable over time. Okay, so example of a flow variable is, okay, let's say the GDP of a country, the annual GDP of a country from 2020 or 2000 to 2024. That is okay. So I think that leads us to these types of data in econometrics. I don't know. We have panel, cross-sectional, and which one? No, she time series, Connie.
Time series.
Yeah, time series
Time
data.
series.
So,
Cause
so
sessional time series as
there's
well.
sir, sir.
Cause sessional time series.
Yeah, yeah. Panel, cross-sectional, time series. Those are, they define those data and those kind of data now. The kind of data for a particular period of time, another kind of data for a period of time, and stuff like that. So that is how we relate this here. Okay. For stock, it is at a point in time. Okay. What is the debt of Nigeria in year 2023? That is a stock variable. What is the GDP of Nigeria from year 2000 to 2024? That is a flow data. That is over time. What's the GDP of Nigeria over time? That is a flow variable. So also, I would like us to understand the concept of real and nominal. Real and nominal. Okay. So real, in economics, there are several things that has the real and the nominal type. Okay, we have the real income, the nominal income. We have the real GDP, the nominal GDP. We have the real interest, the nominal interest. You get? So what are the differences? So basically, when you are talking about nominal, so this is not something to cram, just in case. What is nominal income? So when you're talking about nominal, it's talking about the face value of that particular thing. Okay, it's talking about the face value. Okay, okay. This is sounding familiar. Face value, is that not investment? I'm traumatized. Okay, that's by the way, sha. So it is the face value of a particular thing. Okay. Meanwhile, for real, when you are talking about real, you are factoring in, the concept of inflation. You are taking the effect. You factor in, or you take into account the effect of inflation. Okay. So when we talk about real income, it is the face value of one's income. That is, the income, the actual income before you adjust for inflation. Okay. It is the actual income before you adjust for inflation. Meanwhile, the real income, it is when you have factored in the effect of inflation on that your income. And the essence of doing that is to get the original purchasing power of that your income. Okay. So for example, 100k. 100k is nice. It sounds big. But when you factor in the rate of inflation, you now be like, wait, oh, what can this 100k buy? That is the real value. The nominal value is the face value, like 100, 100, 1 to 100, 100,000. You're a big boy, baller. But then factor in what's it called? What's this? Sorry. What be this? Okay. Okay. Factor in the effect of inflation. That's when you now know the real, okay, as name implies, the real income, the purchasing power. Okay. Likewise, the nominal rates and um real rates. Nominal is the real, the face value, the actual value, without factoring in the interest rate. So the difference is that for nominal, you are not factoring in interest rates. For real, you are factoring in interest rates. You can cram that one, sha. You get. You are permitted to cram that one. For nominal,
Sorry.
you are,
Sorry. Prof, please,
yes, sir.
is it interest rate or inflation?
Interest rate. That's what the lecturer okay, of course. I don't think do we have nominal
Solomon,
inflation rate?
It is
Solomon,
it is inflation, inflation, inflation. That's what leads
Is it?
to GDP, the GDP deflator. We have GDP deflator where you divide your nominal by real. That gives you a GDP
Yeah,
deflator,
yeah, yeah. No,
right?
no, I've not even gotten there.
I think you should start moving on to national income accounting now. It's already past 10 now. We're moving on
Oh
to
my
another
god.
topic from 11.
Solomon.
Don't
Yes,
worry.
sir.
Look, guys, so what I will do is that there is a book that the lecturer is using for us. I don't know if you guys have it. I will share that book so you can quickly read up on this thing that he has taught us. I will share the book now. So let's move on to national income accounting now. I will share the
Okay.
book so everyone can read up. Yeah.
Okay.
Solomon,
Yes, sir.
if we take this thing back to investment, can we say the current market value of a bond is the nominal value and the bond value at the end of the bond tenure, trying to see what the value will be, is the real value?
Is the real value.
I'm,
Okay,
I'm
so
asking.
the actual market price of the bond, I would say, I don't know, I'm not so good in investment, but I would say is, with this little knowledge, I would say is the nominal value. Okay, but after you have factored in all these rates, our discounting factors now, you get then you get that what's it called? What did you call it now? The um
The
that
real.
last one I might get that redeemed value,
Present,
sha. You
present,
get
present value.
what you say? The present value.
Present
Ehen.
value.
Exactly. The present value would call that the real, because we have factored in some things. Okay, we have factored in the rates, the interest rates, and then, okay, in some cases, inflation rates too. Okay, so the present value can be referred to as the real the real value of a bond. Okay, the real value of the bond. So that's by the way. Okay, so moving on
So
to
so
national
so
income accounting.
so
Sir?
so if CBN is trying to defend naira, that means the exchange rate we are seeing is nominal. But when we allow it to be flown through the force of demand and supply so that we can see the real value, so that will make the exchange rate we are seeing real, abi?
The real, yes. So I really don't have much points to back that up, but with my what's it called? With my little understanding of what real and nominal value is. So, like I said, nominal is the actual from the source, the actual. Okay, but when some other factors has been, or when some other factors has been considered or has been, imputed, and then the value changes at the end, then that is the real value. Okay, there are several things, there are several factors that can
My
affect.
my net income every month, is it real or nominal?
Your net income. Your net income is your face value. That's your nominal.
Okay.
You
Hello,
get.
I'm just trying to relate it with
You
things that will
can
make
you
me
can
to.
divide it
I don't
yourself
want
to
to
get the
cram.
real.
I don't want to cram, so I'm trying to relate it with things that will make me
Solomon,
to relate.
can I ask a question?
Okay.
Okay, so when you're talking about nominal and real, in
Yes, sir.
context, are you trying to say that the nominal, for example, in terms of money, let's say like 100,000, that's
Yeah.
the face value, right? Why the real should be the purchasing value of
Yeah, the
the
purchasing
100,000?
power. Yes.
Okay, that's the real.
Yes. That's after you
Okay,
have factored in the inflation rate in the nation. You now know what the actual value of that your 100,000 naira is. What is the
okay,
purchasing power? Okay, that's the real value of that your income.
thank you.
Okay. So basically, if you have to get real value of anything, just factor in, you know, some rates. I mean, the rate of inflation, okay, or deflate it. So real GDP and nominal GDP. Nominal GDP is the actual total value of all the goods produced within the country, okay, without adjusting for inflation. But real GDP is the total value of all the goods produced in a country after you have adjusted for inflation. Okay, that's when you introduce the GDP deflator. So basically, your real GDP, please, if you can cram this formula, cram it. Your real GDP is equal to nominal GDP divided by GDP deflator. In some cases, the GDP deflator can be your price index. Okay, that's your, what's it called? Is it not CPI, Consumer Price Index? You get.
Is,
So
is it in our notes?
you mean the formula?
Yes.
Yes.
I think
Yes,
so.
yes, it's yes.
I,
So in fact,
I think it is.
I've just dropped a material now. Hello, I've dropped a material now. Study chapter 1, 2, 3, and 17 for tonight's discussion. Chapter 1 is on the introduction. Chapter 2 and
What's out
3
of
is on
the
national
exam?
income. Then
Sorry, no.
chapter 3 is on theory of consumption. Just glance through those chapters. It's in line with, it's almost the same. That is where they copied the notes from. So the class note, they
Every
copy it from
note.
the book directly.
Let's move to late.
So just study it. Oh yeah, Solomon, national
Chapter
income.
1, 2, 3,
Let's
7,
move on.
sir.
1, 2, 3,
17,
17, I
17
think,
is
right?
stated. I've stated it there. 17. Yeah, yeah, yeah.
Okay,
Check
thank you,
the group
Casey.
chat.
Okay, thank you, Casey. All right, so moving on to national income accounting. Moving on to national income accounting, okay? So when we are talking about national income accounting, what we are trying to achieve is to look out for the economic performance of a country. Okay, so when you are trying to calculate the monetary value of the goods or the activities in an economy, then we are saying, I mean, we are using the concept of national income accounting. National, okay? You are trying to monitor, I mean, to get the monetary value. For example, all these what's it called? The goods and services produced within Nigeria. You are trying to sum everything up and get a monetary value. Okay, that is what we are trying to achieve in national income accounting. So national income accounting intends to get the performance, the economic performance of a country. Okay, nevertheless, there are some concepts used in national income accounting. Okay, there are some concepts used in national income accounting. But before I go there, I want you to know that there are some approaches too. We have three major approaches uh, in what's it called, in estimating national income accounting. Okay, but the prominent one that we've been using all this while is the expenditure approach. Okay, we have the expenditure approach, we have the factor income approach, we have the output approach. Okay, so when we use the factor income approach, when we use the factor income approach, it means we are summing up all the rewards of the factors of production. So if I ask you what are the factors of production, I think we have four. We have land, labor, capital, and entrepreneur. So in this approach, if we are to calculate national income accounting using factor income approach, as name implies, factor income approach, meaning that the income of each factor of production, that is the reward of each factor of production, we are summing them up to get, the performance of a country. So that is how the approach works. Okay, in this approach, we sum up all the rewards of the factors of production, which I've just listed. So for example, the reward for capital is interest, if I'm not mistaken. The reward for land is rent. The reward for labor is wages and salaries. And then the reward for entrepreneur is profit or loss, or God forbid loss. Okay, profit or loss. So when we sum up all these rewards, in this approach, we use all these rewards. When we sum them up, we use them to determine the economic performance of the country, that is the national income accounting. So that's one approach. The second approach is the output approach. Output approach. Okay. This one, we tend to sum up the total production, the total goods produced, as the name implies, output. Okay, the output approach. And then lastly, which is the most prominent one, is the expenditure approach. Now, this expenditure approach, as name implies, expenditure means expenses. It sums up all the expenses that takes place. I mean, all the expenses that take place in a country. Okay. Now, who are those that can incur these expenses? The consumers, the producers, the government. So when you sum up the expenses incurred by these three economic agents, then we have the expenditure approach. We use that to measure the the monetary position, the monetary value of activities in a country, the economic activities in a country. Okay, so why is this the most important? So exponential approach measures the GDP, and I said that the GDP is the most, I think I mentioned it, let me see it. Okay, let me even read this one sef. Let me read this. So NIA, that's National Income Accounting, is a concept of macroeconomics that intends to measure the monetary value of the goods and services produced in a country during a particular period, usually a year. And I said the major determinant of economic performance of a country is the GDP. Okay, that is the major determinant of the economic performance of a country. That's why if you want to measure the economic growth of a country, you use GDP. Oh, what's the GDP of Nigeria in 1999? Compare it to the GDP of Nigeria in 2017. What is the growth rate? Okay. Now, why are we using GDP? It is because that's the most feasible way. What's GDP itself? GDP is the total goods produced. Okay, the total goods produced within an economy, goods that are domestically produced within the geographical area of a particular country, usually so GDP is calculated yearly. Of course, we have this quarterly um, estimation, like, okay, the GDP grew so percentage in first quarter, okay, it's grew again in the second quarter. But if you are to put it in books, to measure, to measure the economic performance, it is usually estimated yearly. Okay, and then the most viable approach is the expenditure approach. Okay, what do I mean by expenditure approach? It is this one that what's it called? This formula. Okay, so okay, all right. So this was the formula I stated earlier. The real GDP is equals to nominal GDP divided by the GDP deflator. So look at this example. If the nominal GDP of a country is 500 million and the GDP deflator is 105, meaning prices have increased by 5% from the base year. That's 105 now. Okay. Now, what is this? Inflation now. You have factored in inflation. Prices have increased by 5%. Now, this is the GDP here. That means you are factoring in the effect of this inflation on the nominal value to get your real GDP. Like I said, real GDP is the total value of goods produced after being adjusted for inflation. Okay, so you can see usually I would say that the nominal value is usually greater than the real value. The nominal value of a thing is usually greater than the real value. The face value of a thing is usually bigger than the real value of that thing. Okay, so that's that about that. That's just a deviation. Okay, that's just a deviation. Okay, so that's, by the way, on the introduction to national income accounting. I've discussed what national income accounting. No, I'm not done yet too. It's just the introduction to, because I'm still moving to what's it called? All this GDP, NNP, I know. Okay. And then we'll move to I think we've been discussing national income accounting. We've been discussing it for a very long time. All this Y plus, I plus, G plus, can you call like that? Okay. Even myself, I don't tire. Okay. So I've discussed what we intend to achieve in national income accounting. The essence of national income accounting is to know the monetary value of the goods produced, or the monetary value of an economy. Okay, so and I said the most viable tool used to measure national income accounting is our GDP. That's the total goods produced within the geographical area of the country. Okay, and then we have the types of GDP. We have the nominal GDP and the real GDP. Real GDP is the one, it's GDP adjusted for inflation. So how do you get real GDP? That's nominal GDP divided by GDP deflator, which will be given in the question. Okay. Nevertheless, there are other concepts. There are other concepts of national income accounting. And what are these concepts? We have the net domestic product, NDP. Okay, net domestic product, NDP. Okay, we have the GNP, that's gross national product. So before I move to gross national product, let me explain how to ascertain NDP. Now look at it. I'll bring in the concept of accounting. Okay, so to get ah okay to get the net value or net profit, let me put it that way. To get net profit is gross profit minus expenses. That gross profit is the profit you made before expenses, are deducted. But your net profit is like your actual profits at the end of the year. After you have deducted all your expenses, the remaining one is your net profit. Likewise, net domestic product is your gross domestic product minus depreciation. Depreciation is an expenses now. Is an expense. Okay? Depreciation is an expense. So to get your net domestic product, you deduct what's it called? Depreciation from your gross domestic product. So NDP, net domestic product, is equal to GDP minus depreciation. NDP is equal to GDP minus depreciation. Okay. Now, there's also what we call GNP, that's gross national product. The first one is gross domestic product. Now, emphasis on domestic. That one, it only captures goods produced domestically. But gross national product, it factors in production by the citizen of a country in other countries abroad. For example, if Dangote has, let me use Tony Elumelu. Okay, I think he has some businesses outside Nigeria, Uganda, Gambia, and all, or banks. Some banks have branches outside Nigeria. Okay, now these banks are owned by indigenes of Nigeria. Okay, now if you have to calculate the GDP of Nigeria, gross domestic product, all you need to do is just to sum up the economic activities within Nigeria. Okay, but if you have to calculate the GNP, national gross national product, you are factoring in the economic activities of your indigenes in other countries. So if you have to calculate GNP for Nigeria, you factor in the income that Jimovia is making in Gambia or UK. Whatever profits the company is making there, there's a share of it in Nigeria. Gross national product of Nigeria. So basically, gross national product is equal to your GDP, that is income made domestically and income made abroad by your indigenes. If Dangote has company in Côte d'Ivoire, to calculate the gross national product of Nigeria, you are factoring in the profits made by Dangote's company in Côte d'Ivoire. Okay, you are factoring in that. That is gross national. Please get the difference. Gross domestic, that one is within domestic. National is both domestic and internationally. Any company owned by your citizen outside, whatever profits they are making, you factor it into your gross national product. So please, all this little formula, we might say the man will not set question on it, and he set it. Just know it. It's simple to understand. Okay, so like I said, NDP, that's net domestic product, is GDP minus depreciation. Just use the concept of gross profit and net profit. Net profit is gross profit minus your expenses. We all know that depreciation is an expense in accounting. Okay, so just use that one too. NDP is gross domestic product minus your depreciation. Meanwhile, gross national product, this one is different from gross domestic product. National product, it factors in both domestic and international income. So that's why we have GNP is equals to, I even wrote it here. Look at it. GNP, that's gross national product, is equals to your GDP plus factor income from abroad. Dangote is an entrepreneur, is a factor. His income abroad, you add it to GDP of Nigeria to get your GNP.
Yeah, Solomon.
Yes, sir.
Solomon.
Yes,
Okay,
sir.
what is the implication of goods produced in Nigeria by non-Nigerians when calculating GNP? Like you have non-Nigerians producing goods in Nigeria. How do you adjust for that in your GNP? Because GNP basically is for your citizen, your nationals, right?
Yes.
So can you explain that?
Yes. Okay. So I believe that whatever business owned by a foreigner in Nigeria, is the resources used to what's it called, to run that business is still within Nigeria. Of course, Nigeria would so I believe there will be a percentage. Okay, I really don't know the internal calculation they do, but there will be a percentage. For example, companies owned by foreigners, the country of those business owners has a percentage in the profit they are making when they are calculating their own GNP. But for Nigeria, like we said, both foreigners and indigenous businesses, in as much as the goods is being produced on Nigerian soil, it is calculated as part of our GDP. It is produced domestically. For example, expression owned by all these Lebanese, whatever profits they make, okay, whatever production they make is counted as production within Nigeria, and it will be considered as part of our GDP, because we are using Nigerian resources. Okay, we are using the labor, not that they bring their okay, not that they imported their workers to come and be running the factory. They are using our labor, they are using our capital. Okay, if they are to get loan sef, they get loan within. They are using our land. They are all those things. Okay, so in as much as the good is produced or the production is being made within Nigeria, it is part of Nigeria's GDP. Nevertheless, some cuts might now be going to their own country, their individual countries, as factor income from abroad. But basically, Nigeria is taking a major part of the activity. The proceeds. Okay.
So that means if they are silent, we should just take our GDP plus the factor income from abroad and move on, Abi.
If they are
they are silent on whether we should adjust for non-nationals in Nigeria. We should just take our GDP plus factor income from abroad and move on, right?
Okay, yes. Like if they are silent, Abby, if they are silent
Yes.
on what?
On the non-nationals that are in Nigeria now.
Oh, okay. If they are silent on it, then John Gugbo Epo. You get.
So
But
Solomon, there are
really,
still like there are three areas that I still want you to cover for us in national income. I don't know how you can do
okay,
that in
what's
30
that, sir?
minutes before we start the third one. Balance budget
What's
theorem, then the calculation, that long calculation of CYG, all those ones there, and also the which one is the third one? Multipliers. I don't know how can you touch these three in 30 minutes.
okay. All right, let's just touch that. Let's touch that now. But really, just try and understand all these terminologies. Okay, all this NNP, like in the same way GNP is with GDP, is the same way NNP is with GNP. You just deduct the depreciation, okay, and then you are fine. So that's by the way. Now, considering the proper calculation under national income accounting, I said the prominent, okay, I said the prominent approach they use is the expenditure approach. Expenditure approach. Okay. Now, what do they do under this expenditure approach? They sum up all the expenses incurred by economic agents are summed up to ascertain the national outputs. Okay, so ascertain the national outputs, and that is where this formula comes from. Y is equal to C plus I plus G. Now, this C is representing one economic agent, which is consumer, the household. This I is representing another economic agent, which is the firm or the producers. That's the producer, the firm sector, the producer sector of the economy. And then this last one is the government. Now, what this approach is saying is that sum up all the expenses incurred by these three agents, and then you get your output. That's your national income. So sometimes, don't get it confused. They will say calculate the output. Sometimes they will say equilibrium national income. National income. Which other thing? I think these are the two major. So sometimes they will just say calculate the GDP. Oh, what's this? GDP. So sometimes they will say calculate the GDP of the country. Okay. Now don't get it twisted. Y represents all. Hey, wow. This Y represents all. So you can either call Y as the output. You can call Y as, you can call Y the GDP. You can call Y the national income. Okay. So now, expenditure approach says sum up all these expenses, and then you get your GDP or your national income or your output. Okay. Now, how does these three represent the expenses of these economic agents? Okay. You will know now that for consumers, they incur expenses on consumptions. Okay. What are the things they consume? They can consume goods and they can consume services too. For example, you want to barb your hair just say, give me the barber share. Just go to your barber shop, cut your hair. You are consuming a service. You are, incurring an expense. You bought a goods. You are incurring an expense. That's so. When I say consumption, it's not just food, though, because some of us say to have the consumption, maybe amala. So consumption is not just streamlined to the food you consume. Consumption can be services you enjoy. It can be the clothes you buy, whatever demand, whatever thing you need. Everything is just summed up as your consumption. So all the expenses incurred by the household is called consumption. Meanwhile, for investment, it represents the firm's expenses. That's the investment, the capital they use to set up a business is an expense to them. Okay, they are spending money to set up business. That's an investment. Okay, so that is the expenses of the firms of um the firm sector of the economy. And then government spending, that one is straightforward. Government spending, that is the amount of money government spends in producing public goods. Public goods like, okay, free schools, good roads, bridges, pipe-borne water and all those, and probably even setting up some organizations so that they can employ labor. You get, so all these expenses are used to, when they sum them up, it's equals to the national income of the country. Okay, so basically, hey Jesus, how many minutes? 20 minutes. All right, so I'll just rush through it. So we all know that our consumption can be, autonomous. I don't talk this entire, but then please just follow. Okay, our consumption can be. So now I want to delve into the concept of multiplier. That's the reason I'm doing this thing. So I want to use just this one stone to kill 52 birds. Okay, so our consumption is A plus B, where your A is should I type? Maybe I should go up. Let me go back up so that it will be fast. I don't want to be typing. Okay. 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 All right. So let me bolden this. Let me bolden this. All right. Okay, so now this is the algebraic determination of the equilibrium income. Okay, so look at this. You can see this one is even quite different from the one I stated earlier. Your Y is equals to C plus I plus G, and then plus your net export. That is when you have the presence of international trade. When your country is involved in international trade, there's no state of autarky. Okay, but basically, these are the three major agents of the economy, the three economic agents, okay? But we factor in net exports if the country is interacting with other countries in international trade, okay? So, like I said, your consumption is a function of your income. That is, when your income increases, your consumption increases. There's a direct relationship, okay? And I said this consumption is equal to your autonomous consumption A plus BYD. Okay, this B, I've labeled it here. B is your marginal propensity to consume. Okay, and it has its value between 0 and 1. That is, B can be in between 0 and 1. That's from 0.1 to 0.9. Okay, 0.1 to 0.9. Okay, so is it 0.9? 0.99. I think it's 0.99. Yeah, 0.99. Okay, so that's your marginal propensity to consume. That's your B. Okay, this A is your autonomous consumption. All right, so A is your autonomous consumption. That is consumption that is not affected by your level of income. Okay, it is not affected by your level of income. Okay, and then this B YD, that is everything together now, is an induced consumption, meaning that if your income increases, this YD is your what's it called? Um disposable income. Okay, disposable income is your income. Look at this here. Disposable income is your income minus tax. I don't know if this is effective as I'm rushing, but then please follow through. Please, if you do not understand, come attention. Okay, but then so when your disposable income increases, okay, your consumption increases. Okay, so your disposable income is your income minus tax. And also, we know that tax can also be lump sum or can be induced too. Okay, so this your T is the marginal rate of tax. All right, your TO is your lump sum tax. It does not vary with your level of income. Okay, and I've cited example of some lump sum
Solomon,
taxes. Yes, sir.
is lump sum the same thing as autonomous tax?
Yes, autonomous. Yes, yes, sir.
Okay.
Yes, sir. So, um, and then also, it is assumed that your I is autonomous, government spend. I mean, your investment is autonomous, government spending is autonomous, and then your export is autonomous. Okay. Likewise, your what's it called? Your import can also be autonomous imports and induced imports. That is, the imports that increases with your level of, you know, what's it called? With your level of income. The more income you make, the more purchasing power you have to import. Okay, so that's by the way. So all I did was to impute all these breakdowns, all this breakdown. Now, please note that when you are solving national income accounting, first of all, you need to understand what economy are you running, which economy are you, what kind of economy are you finding income for? Okay, that's the first thing you ask. Is this an open economy or a closed economy? If it's a closed economy, then there won't be international trade. So how do you know that? Look out for your parameters. Okay, look out for the parameters given. So if they give you X, that's your export, and they give you M, that's your import, just know that that kind of economy is what's it called? Is an open economy. There is no autarky. That means the economy is involved in international trade. Okay, so when you factor it in, then your formula will be, I mean, your equation will be this, all of this. But if there is no international trade, then you don't need to put this net
Solomon,
export, this X minus M. Yes, sir.
please. Autarky means closed economy. Am I correct?
Sir?
Autarky means closed economy.
Yes,
Is that
autarky.
correct?
Yes, yes, sir. When there is
Okay.
autarky, it means there is no foreign trade. There is no interaction with other countries. I think
Okay. Thank you.
which country is doing that now? Say North Korea, Korea, I don't know, sir. For that's it, sir. For autarky, there is no international trade. Okay, it is a closed economy. Okay, so all I did, so like I said, the reason why I'm using this is because I'm assuming an open economy. So don't get it twisted. You'll be wondering, well, guy, now why is equals to C plus I plus G you'd use before? Which one can be X minus M? This is because this is an open economy. There is international trade. But if there's no international trade, remove your net exports, remove this one, and then you are left with C plus I plus G. Okay, so all you need to do is just to substitute each of these parameters into your what's it called? Your underlying equation. So this is your underlying equation. Whatever you want to do in national income, first of all, state this equation. And I said this equation is dependent on the kind of economy you are operating. Okay? If there is no international trade, there's no point putting x minus m. Just write y is equal to c plus I plus g. Okay? And then you'll be fine. So this is your underlying equation. So whatever you are doing, just look out for each of these parameters. Okay? And substitute them. So that was what I did here. Now look at it. C is equal to a plus byd. Yd is equal to y minus t. T is also equal to t naught plus small letter ty, and then others are autonomous. And then your import is also autonomous import and then induced import. So all I did was just to substitute all those things up here, substitute them into the underlying equation that I stated earlier, which was this. Okay, substitute them into it. What's our C? C is A plus this CC. This is the whole of C. Okay, this is C, A plus BYD. Come, look at it here. This is C is equal to A plus BYD. So that was what I did here. Plus I said your I is autonomous. This I is equal to autonomous. Look at it. I is autonomous. G is also autonomous. Okay, that's G is equal to G naught. And then X is equal to, X is also autonomous. That's, and then minus, look at this, minus M. Okay, now what is M? This is the whole of M. This is M. Okay, M, you now substitute, anywhere you see M in this equation, you now substitute these things there. That's what I did there. Okay, and then normal, okay, the third line, our A is equal to B into brackets Y minus T. Where did I get this Y minus T from? This YD, you can see this YD. Look at it here. That's your disposable income. Disposable income is income minus tax. Okay, so Y minus T. I just substituted Y minus T, then plus this. What I did here, okay, and then the fourth line, look at it. You'll be wondering, why is this thing becoming more complex? All I was just doing is just to substitute. There's nothing difficult in it, okay? So A is equals to, Y is equals to A plus B into brackets, Y, this is the Y, okay? Now, T is also carrying some babies here. Look at these babies, okay? T naught plus Ty. All I did was just substitute it into it. Anyway, I see T here, just substitute the babies there, okay? And then rewrite all these things, write them out again, okay? And then all I did here was to expand this bracket, okay? Look at this, minus T naught plus Ty. This minus will affect everything in this bracket. So minus times T naught minus T naught, minus times plus, minus then your Ty, okay? And then also this place, all I did was also to expand this bracket inside your block bracket here. So minus times M naught and then minus times plus my. That's what I did here. And then I got all this. So after getting this, the next thing to do is to collect like term, meaning that you see this capital letter Y. Anywhere you see capital letter Y in the equation, put everything together. Put everything together. So that was what I did here. So this, plus by, I took it to meet this big Y here. So that's minus by. Likewise, this one, minus bty, I took it, I crossed this equal to sign. It's turned to plus bty. And then likewise,
You are collecting like terms.
Collecting like terms. Thank you very much. Okay, so that's, by the way, after collecting your like terms, you now factorize. Okay, there's something common among all these things, which is y. Factorize y. Okay, so this y outside, and then you put the remaining in the bracket. When you take y out of y, it remains 1. Abi, when you take y out of minus by, it remains minus b. When you take y out of plus bty, it remains plus bt. If you take y out of this, it remains m. Okay, put everything in brackets, and then all you need to do, we are trying to make y stand alone. Okay, so divide both sides by 1 minus b plus bt plus m, and then you get this. Now, this is your equilibrium income. This is your equilibrium income. Now, do you know why this is technical? It is because we are using algebraic. If you are using number, you won't be having long things. You would have added them now. For example, if you have 5 plus 2 plus 3 plus minus what you add, your equation will become shorter. So when you learn the harder things, the simpler ones will be, of course, as the name implies, will be simple. Okay. A smooth sea does not make a good sailor. It is that rough, roaring thunder and roaring sea that would make you a good captain. Okay.
No talk that one. Shall I just continue with your economics? No talk that one. You don't work.
Okay. So now, moving on to the concept of multiplier here. Okay. Now, look at this. Look at this equation. This equation can be otherwise rewritten as 1 over, listen, 1 over 1 minus b plus bt plus m times a minus bt naught plus I naught plus g naught plus x naught minus m naught. Hey, some people will like, oh my, is this guy rapping? Well, I'm not a rapper, but then just open your mind here. Okay.
Solomon, please zoom more.
Okay. You feel me?
It's
Yeah,
okay.
correct.
Take it back a little.
Solomon, you need to wrap up in
Oh,
5 minutes or
no,
6 minutes.
Okay, sir.
It's fine.
I
It's
just
fine.
want
Round up
to
in
I want to
about 5
I just
minutes
want
or
to explain
thereabout.
how to get our, sir.
Wrap up in 5 minutes so that we can take consumption before we go.
Okay, sir. I also want to take our multiplier and then I'm done here. Okay. Now we have gotten how to we have understood. I don't know if we understand, sir, but then this is how to get our equilibrium income. Okay. And then to get our multiplier, when you are calculating, for example, calculate the tax multiplier in this equation. When you are calculating the tax multiplier, now listen, multiplier is a tool used to measure the rate of change in income due to a change in autonomous consumption, or I say consumption, in autonomous spendings. Now, if you take a note, take a look at this equation. Everything on this numerator, all of them are autonomous. This A is autonomous consumption. This T naught is autonomous tax or lump sum tax. This I naught, autonomous investment. G naught, autonomous government spending, autonomous exports, autonomous imports. Okay. Now, to get the multiplier, the multiplier simply is to check the rate of change. That's why when you're calculating multiplier, you use differentiation, rate of change, dy d something, delta y divided by delta something. That is how to calculate multiplier. Okay. So when they ask you, calculate the multiplier of tax, that is tax multiplier. Let me give you the trick. I don't want to write that formula. That what's it called? Quotient rule formula. I don't want us to, okay. But here, if you have to get the tax multiplier, all you need to do is look out for the what's it called? The coefficient. What's the coefficient of a number? It is, the coefficient of a variable. It is the number standing beside that variable that is the coefficient. For example, if you have 3x, the coefficient of x is 3. If you have 3y square, 4y squared. The coefficient of y is 4. Okay. Likewise here, look at the coefficient of T naught. You know, T naught is the tax, is the one representing tax in this equation. Tax multiplier will therefore be, look out for the, what's it called? The, hey, Jesus, can you for coloring? The coefficient. Okay.
Coefficient.
Now, yeah, the coefficient here, the coefficient of T naught is what? Minus B. Okay. All you need to do is just to divide the coefficient of that thing, divide it by the numerator, period. Okay. For example, the tax multiplier will be minus B divided by this denominator. Okay. The government spending multiplier, what is the coefficient of government spending here? 1. Invisible 1. So government spending multiplier will be 1 divided by the denominator. Okay. The let me this is the, please answer my question. What is the import multiplier? Import multiplier.
Minus one.
That's it. Is that it?
Yes,
For you,
that's
me.
it.
Sir?
For you,
What's the import multiplier? Mo sọ pé import coefficient o.
That's minus 1 all over 1
One.
all over 1 minus B plus BT plus N.
Exactly. Thank you, Professor Alabi. So the import multiplier will now be the coefficient of import, which is minus 1 divided by the denominator. Likewise, what is the investment multiplier? Investment multiplier will now be 1 over the denominator. Okay, that is what's it called? That is the hack, on how to calculate. So look at it here. Look at it here. You can see, if you are to get your investment multiplier, this is the formula you use. You now be going through all this process, only to arrive at this at the end of the day. 1 over, you get. Likewise, for tax multiplier, okay, for the tax multiplier, look at it. Tax multiplier from this equation, the tax multiplier will be what? Who can tell me? Tax multiplier.
Minus B over 1 minus B.
Thank you. Minus B divided by 1 minus B. What's the government spending multiplier?
1 divided by 1 minus
Now
B.
is 1 over 1 minus B.
Thank you. The investment multiplier.
1 divided by 1 minus
1
B.
over 1 minus B.
Thank you. So that's it. That's the hack. You don't have to, though, if you are solving theory, lecturer, because the lecturer took time to solve all these things in class. So if you now want to answer question, you get, find the lump sum tax multiplier, just try minus 1 over B. It might just give you half mark. So me, I will advise, because the man took his time to, solve all these things in class. So please, if you can learn this, what's it called, quotient rule, please learn it for the sake of theory. Adibin is OBJ now. I just to look am tick, but theory he go show workings, so no be by church or church. So that's by the way. And then for the oh my god, it's 11 p.m. For the balanced budget, that one is quite easy. I can just explain that next Thursday for a start, and then we move to the more complex topics, which are all these sticky price model, all these AROD, what's it called? Aggregate supply, ISLM
Okay,
and Google to be like that.
we'll
So
conclude the remaining part on Thursday. That aggregate
by God's
demand,
grace,
aggregate
by God's
supply,
grace,
ISML call for those ones. So okay, so let's
by
take
God's
one more
grace.
topic tonight before we go. That's theory of consumption. So I hope that our facilitator, our tutor is ready for that. Theory of consumption.
Let me stop sharing my
Oh,
screen now.
is our tutor ready? Oh?
Good evening, everyone. So, please, can everyone hear me?
Yes, very well.
Okay, Kazim, please, can you let me share your screen now?
Okay. The voice is actually fainting. No?
Can you hear me now?
Better.
Yes,
Better now.
please.
Yeah.
Hear you loud and clear.
Okay.
Sure.
Okay. So,
All right, Solomon,
let's
thank
wait
you.
for.
Solomon, we appreciate you.
Yes, sir.
Thank you, Solomon. Thank you.
Thank you.
Yes, ma'am.
All right, let's start.
Kazim, I'm not seeing your screen.
It's up actually. It's up. Oh. Can anyone view my screen?
Yes, okay.
Okay,
Yes,
Yes, I
up. The
can.
screen is up.
Oh, I can't. So, okay, I'm coming. Please just give me a minute. Can you guys hear me?
Yes.
Yes,
Okay, so let's start. So I'll be taking us theory of consumption. We've done this before. So it's just like I'm going to be summarizing our notes, that long note. So I'm going to be summarizing it. So theory of consumption explore how individuals allocate their income and consumption between consumption and savings. So I think by now everyone should know how to write consumption function. Am I right?
You are not right.
Okay, so we all know that we all know that our consumption is a function of our disposable income, right? Whatever you consume is dependent on the money you have. So then we know that our consumption, most of us pay our Lagos State tax, FRS, our companies pay FRS, Lagos State tax. And we all know that our disposable income is our gross income minus our tax, right? Okay, so let me move on. So Kazim, can you hear me scroll up? Okay, so I'll move down to Keynesian consumption function. So we have about six um six authors. Let me put it as six authors that talks about consumption function. We have Keynes, we have Ibn Fisher, we have Simon Kuznets, we have Friedman, Newton, we have who again, Robert All, and so on. So we are going to see how Keynes, how he studied consumption. What did you understand by consumption? How he determined consumption, but how he determines consumption and all. So now let me start with Keynes. Keynes. So James came up with let me say conditions, three conditions for consumption. The first one is that our marginal propensity to consume is between 0 and 1, is in our notes. Then our average propensity to consume it falls as our income increases. Our C over Y falls as our income increases. And the third one, he said that the major determinant of consumption is our income, it's not our interest rate. And we all know that interest rate is gain on savings. Like now, for instance, different we all have different ways in which we invest our money, in which we save our money. Some people invest in treasury bills and they earn interest at a particular point in time. Let's say in few months, 91 days, 182 days. So that interest, like what is gained on their savings. But we are what Kane said is that our consumption is not dependent on that interest rate. It's dependent on our consumptions. It's dependent on our income. Sorry. So let's move on. Please, are you guys with me? Am I too fast? Do we all understand?
Yeah, continue.
Go on.
Okay, so let's start with Keynes consumption function. So we have John Maynard Keynes proposed the consumption function, which suggests that current consumption is primarily determined by current income. Whatever we are consuming today determines on what we have today. I have 10,000 naira today. What I'm going to consume for the rest of today is dependent on that 10,000 naira that I have in my pocket. That is what Keynes is telling us. Whatever I have today is dependent on what I have in my pocket today. So, and he introduced the idea of marginal propensity to consume. We all know what marginal propensity to consume is, right? Can you move up a bit, Kazim? Can you move up a bit? Where we have our C is equal to A plus BY. So sorry, I'm unable to share my screen. Okay, so we all know that our C is equal to A plus BY. Our A is our autonomous consumption, while our B is our marginal propensity to consume. So, and we all know that, like yesterday, Kazim took us through econometrics, and we talked about when income increased by 1 naira, our marginal propensity to consume will increase by 45 kobo. Do you all understand? So, what it means is that once our income increases, our marginal propensity to consume also increase, but at a decreasing rate. Like now, I'm earning. Let me say I earn 15,000 naira today. Let me say I'm not a laborer, but let me just put it like all these laborers on site. So they earn their money daily. So let's say now I used to earn 10,000 naira, and me on my way to where I'm going to work, I already know say I'm going to earn 10,000 naira today, and whatever I'm going to buy must be out of that 10,000 naira. Must be out of that 10,000 naira. And as I'm earning too, I know that I'm actually saving some little ones. Do you understand? I'm actually saving some little ones. So now, let me say I now earn an extra of 15,000, an extra 5,000, extra of 5,000 naira. After in that extra of 5,000 naira, I'm going to increase my consumption a bit. I used to earn 10,000 naira before. I started earning 15,000 naira. I'm going to increase my consumption a bit. So that is my marginal propensity to consume. So Keynes suggested that income increases, consumption also increases, but at a decreasing rate. As income continues to rise, a smaller portion of each additional income will be spent and more will be saved, which is the truth. They increase your salary this month. You are not going to spend all that increase. Some people even prefer to save the increase. Let me say my salary was 100,000 before, and it was increased to 150,000. The 50,000 extra, I can decide to spend 10,000 naira out of it and save the rest. I'm not spending at that increase. I'm actually consuming in a decreased rate, and I have to save more because I have more money now, and I'll start thinking of that car I have to save for. So that is that, and which in turn it affects our economic activities and policy making. So we all know that our C is our total consumption, and we know that our A is our autonomous consumption, and we know that our B is our marginal propensity to consume. We all know that marginal propensity to consume is also the same thing as um our our slope. And we know that our A is our autonomous consumption. It means that even when that autonomous consumption means that even when our income is zero, there is no how we still consume. So we should all be familiar with these three conditions of consumption. It's in our notes. It's not in this material. The three conditions of Keynes consumption function states that our marginal propensity to consume is between 0 and 1, and the average propensity to consume, that means our C over Y, falls as our income increases. And the third one is that the major determinant of consumption is our income. Can I move on to the next theorem or the next author? Can we move on? Is I need response.
Yes, please. Yes.
Please, do we all understand what I just explained?
Yes, ma.
Okay. Okay, so let me move on. So I'm going to move on to Simon Kuznets and secular stagnation. Actually, what Simon Kuznets and secular stagnation is all about, they were just trying to test Keynes' theorem. They were trying to test what the was it the adequacy of Keynes' theorem. So for Simon Kuznets, he's known for his work on economic growth and income distribution. And this happened during this Great Depression in World War II. Around that time, they think, okay, now after that World War II, it was said that income increases, like the rate at which income increase was very high. The rate at which it increased was very high. So then our what was it? Our C over Y, that means our average propensity to consume, our consumption over income did not fall, rather it was constant. So they said that what Keynes really said was not really that it was not really there. But so let's move on still. So for Simon Kuznets, he is known for his work on economic growth and income distribution. He identified the patterns in economic growth, and in, he's famous for his Kuznets curve. Sorry, excuse me. For his Kuznets curve. So Kuznets' work laid the foundation for the concept of secular stagnation, which was later developed by others. So we all know what secular stagnation is. We all know what stagnation is. Stagnation means there is no economic growth in a market-based economy. So it made significant contribution in understanding how economics develop over time. So let me move down to the summary. Sorry. So his work laid the foundation for gross domestic product as a key indicator for economic health. Solomon has been talking about gross domestic product, and I want us to know that our consumption actually takes the two-thirds of gross domestic product. Sorry. So we have our government spending, we have our consumption, we have our investment. Everything is brought down on consumption. Why do we import? Why do we export? You understand? So it all boils down on that. So for Simon Kuchen, major contribution for the understanding of economic growth and income inequality. The measurement of national income made his work had a lasting impact on economy. So I'm not going to really, really I'm not going to really, really dwell on this. But at the same time, I want us to go through this particular theorem in our notes. So let's move on. I'm going to move on to Ivy Fisher and intertemporal choices. You all know what choices means, right?
Okay, sorry. Let me quickly do like 30-second summary of the first two. There is a key point there. For example, this John Maynard Keynes says that as your income increases, your APC will keep declining, right? That is your average propensity to consume will decline. Then this Simon Kuznets, his own is that he disagrees with Keynes because he's of the opinion that as your income increases, that your APC is expected to remain constant in the long run. So I think this is what this Simon Christian Augustine is talking about, that your APC, so if you want to cram now, you can say John Maynard Keynes says that your APC will be declining. However, Kuznets states that in the long run, your APC is constant. It's not the political party APC. Or APC mean average propensity to consume. Don't think I'm talking about Progressive Congress. So I think that's just a summary for those that probably want to cram the difference between the two. Okay, let's move on.
Okay, let's move on to Ivan Fisher and intertemporal. I'm so sorry, my pronunciation will not be right, so but just manage me like that. So for Ivan Fisher and intertemporal choice. So Ivan Fisher introduced the theory of intertemporal choice. We all know what choice means, right? We all know what choice means. We all know, yes, we should know because every day of our life we all make choices. So it suggested that consumers choose consumption levels based on their lifetime income and preferences. That means as a consumer, you are the one that choose the consumption, your consumption based on your income, your lifetime income. At least, let's say you are working in an organization now, you know what you are, if even though you will stop working there, but your projection is for a year that I'm earning 100,000 every month. At least in a year, I'm going to earn 1.2 million. And inside that 1.2 million, I have to save this for this year. I have to buy this. I have to consume this. I have to work on my I have to have a budget plan. Maybe I want to continue to lavish my money. Maybe in a year, in a month after my salary, let me go and do spender. Let me go and spend all my money. Let me take all my friends out. That one is there. Or maybe my I want to save 60% of my salary. That one is there. Or I want to do this, I want to do that. So but for him, he suggested that whatever we choose now is dependent on our income, our lifetime income and our preferences. Our scale of preference. We all know scale of preference. I think unconsciously we all draw out scale of preference every time. So balancing today's consumption with the consumption in the future. So it's for you to determine, oh, I think I want to spend more today and consume less in the future. Or I want to spend more. I want to spend more in the future and consume less today. Whether you want to consume more today and save more for the future is left to you, or you want to spend more today and save less for the future. So he said that the greater the consumption today, the less the consumption in the future, and the less the greater the consumption in the future, the less the consumption today. So yeah, just for this particular theorem, is balancing the present and the future consumption together. Consumption based on our preferences and interest rates. Let's say, for instance, I decide to keep some of my money in treasury bills, then I will earn more interest. You know how to balance up the future consumption. You understand? Like now, we Nigeria is going through inflation. Let me just say, when you go to the market today, the prices of today is different from the prices you meet tomorrow. So now I have to keep some of my money so that I will balance balance tomorrow's money in order to consume more tomorrow. Because if I don't do that, I will consume less, and I won't want that. I want to maximize my utility. We've all done theory of consumer behavior. So now I want to maximize my utility, but I have a constraint, which is my income. I may desire to do this, to do that, but I have to still think my income should still be what I'm my determinant of whatever I'm doing. So with the income I'm earning today, I have to towards it. I have to save more for the future, right? So, and I have to think of, maybe I have to consume less, or I have to consume more today, or I have to save, I have to consume more or consume less in the future. So let's say now, for instance, we have two phases. We have period one and period two. Our period one represents today, and our period two represents tomorrow. So can you scroll up a bit, Kazim? Kazim, scroll up a bit. So we all know that our savings is equal to our income minus our consumption. My savings, like when I collect my monthly salary, 100,000 minus 50,000 that I want to spend on consumption is equal to 50,000. That 50,000, I'm going to save it. So now let's say I'm putting it in a savings account that I'm going to earn little interest. Are you guys with me?
Yes, please.
Please, do you guys understand what I'm explaining? Any question? Any
Yes,
addition?
yes.
Okay.
Continue,
So
continue.
now, can you scroll up a bit, Kazim? So now, you can see this equation for this period too. Our C2 is equal to our interest rate times the savings we are going to have in the future plus the income we are going to earn in the future. If our what was it? Our consumption is equal to was the interest rate we earn on the savings in the future. Our consumption in the future is equal to the interest rate we earn on the savings we made yesterday plus the income we will collect all join. Which is better? I have 20,000 naira for today. Tomorrow I'm adding 50,000. Okay, let me say I earn 100,000 today. I save 20,000 out of it. Tomorrow I'm collecting 100,000 and I'm adding it. That means the 100,000 plus the 20,000 I have, I'm like 20,000 richer. So in short, what Ivan Fisher is telling us is that we are balancing today's consumption with our future consumption. So can I move on? Can I move
Yeah,
on?
so in summary now, this Ivan Fisher zone is that okay? You have options of either you spend less today and spend more in the
Yes.
future, or you spend more today and spend less in the future. That what you consume is a function of your lifetime income, correct? So if you spend more
Yes.
today, that means you will suffer tomorrow, or if you suffer today, you enjoy tomorrow. Let me just use that street language to summarize it. I don't know if I'm right.
Yes, you are right. You are right. So can we move on? Can I move on? Asoro, Chasi Funmi.
Yes, you can move
Yes.
on.
Okay, so let me move
Continue,
down to
continue.
macromodiglianin and life cycle hypothesis. So now we know we've talked about Keynes proposition. We've talked about Simon Kushnet, and we've talked about Ivan Fisher. Ivan Fisher was it? Ivan Fisher theory of
Temporal.
consumption.
Temporal.
Yes. So now we are moving down to Franco Modigliani. For Michael Modigliani, he talks about the life cycle hypothesis. He view consumption from the life cycle, like from a life cycle view. And we all know what life cycle is. We learned that in our biology, secondary school days. We learned that in our biology. So what he says is that it's just like is dwelling on Ivan Fisher's theorem. What Ivan Fisher says, and Modigliani is dwelling on it. Like, okay, let's say more emphasis. So he developed the life cycle hypothesis. He said that individuals plan their consumption and savings behavior over their lifetime. People save during the working days and they save during the retirement, aiming for smooth consumption in the future. Most of us, you know that we are putting our energy to work now so that we won't suffer in the future, right? Am I right?
Yes, yeah.
And some of us, we have like 50 billion naira in our account now, so that by the time we are 70 years old, we just be, you know, we just be enjoying our life. We don't have to start even looking at our children's face before we eat, all those kind of things. So we know we all have that kind of ideology because we are working towards, enjoying life. So for him, he says that now individuals plan their consumption. I know that I have to eat less so that I can save more. Maybe I'm buying some kind of luxury. I want to buy clothes. I have to follow my friends to the cinema. We have to go around Lagos. We have to paint the deposit. You have to paint the city. I don't know what you're painting the city with, but you have to just, you have to just enjoy your life. But I'm choosing staying in my room, watching, maybe subscribing to 1,600 naira Netflix a month, and watching movies on my laptop. Maybe I will just buy one 200 naira popcorn, add mix to it. I'm not saying that is real, but at least that's part of me. Adding milk inside popcorn and sitting with my Netflix videos and watching Netflix and doing all those things rather than going to the cinemas or painting the something red, going to these days, those things are good ones in a way. I'm not saying they are not good though. I'm just giving an instance. So I'm choosing between that and I'm saving, like I'm saving consciously, I'm saving for the future, for the lifetime. And it's a continuous effort. Because when I'm working, I'm saving more when I'm working. So when I stop working, I have access to my investment. I have access to the money I have saved. Sorry. And you know that savings can come in so many ways. You can invest, you can do that. Some of us have lands that we buy, when it appreciates over the time, we can sell it off and we have more money to spend. So we are using that to balance our consumption in the future. So that is what to ensure smooth consumption. So we are ensuring that at least nothing is tampered with our consumption. Like nothing tampers with our consumption. We continue to enjoy our life, even in our old age. So that is what Franco Modigliani is saying, that he's looking at the life cycle hypothesis, like consumption and saving behavior. Individual plan their consumption and savings behavior over a lifetime. It's like a life cycle. So can we move on? Are you guys in me?
Okay,
Yes.
let me help those that want to cram too with my own jargons. So this Ivan Fuchsia, he said that you have two options. Is either you save more today, consume more. I mean, if you consume more today, you consume less tomorrow, or you consume less today and consume more tomorrow. But these guys now, Franco Modigliani, they are now being, the beneficial world, they were not specific. They gave us the two options to play with. Choose one of the two. Enjoy now, suffer tomorrow, or suffer today, enjoy tomorrow. But this Franco now, they are now being specific that, okay, it is rather better for you to save more today so that when you stop working, whatever money you have saved, you will now be using the money to enjoy. You will be consuming by the time you get to your retirement. So yeah, here they are of the opinion that you should save more today and enjoy when you retire. So, okay, there is one PO that raised hand. The person want to speak. PO Perpetua. Yeah, speak. Unmute and speak.
Okay. So in addition to what you said, this Franco also the same thing what you said anyways, that consumer are able to um move their income from a time when the income is high to a time when the income is low by saving. So just in
Yes,
addition to what you said
exactly.
anyway.
Yes,
Yes, I'm about
exactly,
to make
exactly. When you are working, your income is high
actually.
when you are working, but when you retire, there will be no income. So it is what you have gathered during the time that you are working that you will now be spending on consumption when you retire. So that's exactly what this Franco. Oh yeah, carry on.
In addition,
Carry.
in addition to what Perpetua said, actually, we all know that there are some times that maybe when you leave your job, there are some jobs that maybe because of the toxicity and everything, you have to be out of job for like let's say 2 months or 3 months. Within that 2 months, what you will dwell on is what you have in your savings. So what you will spend is what you have in your savings. So it's like we are saving for rainy season. Abi, is it rainy season? For dry season, sorry. We are saving for dry season. You get? So it's like when we have plenty money, we are keeping some for some dry season. So let me move on. So we are moving on to Newton, Friedman, and permanent income hypothesis. So Newton, Friedman, and permanent income hypothesis. You know, Friedman, we should be familiar with this Friedman guy. So he introduced the permanent income hypothesis. It suggests that people base their consumption decision on their expected average income, like rather than their current income. This implies that okay, so let me explain. So for meeting Fedman, he said that you plan on what you expect. You don't plan on tips. Like some of us, you have some uncles that can just say, send your account, let me send 100K to your account. But he is saying that permanent income, what you earn every day, what you earn every time, what you work for, to plan you plan your consumption on it. Let me say now, I am expecting 10,000 naira from a friend this month, and where I work, I'm paid 100,000 naira. So the 100,000 naira, that is what I'm going to plan on. I'm not going to plan on that temporary income that we receive. That temporary income is just like an addition to whatever I'm receiving that month. So he's saying that we are going to plan our wars, our lifetime consumption. We are going to base it on whatever income that is permanent that we are collecting. I have to fix it around. So he said this implies that temporary changes in income. Let's say in this month, with the extra cash that I received from people, I was able to have 110,000 naira. And in the next month, I have like 100,000 naira, my normal income. Is the 10,000 naira is not having little effect, right? It's just having less effect on my consumption decision. It will still fall to the same thing because I still have to plan on that my permanent income that I earn every month. So that is for Fredman Newton. Does anybody have any addition
Okay,
before I
so
move on?
this Fredman, I mean, thing is saying is that you should plan your income on, you should plan your consumption on those permanent income. So you should disregard your urgent 2K. If you are getting urgent 2K somewhere, don't add it to it. If you have boyfriend that is giving you money, that one should not be planned as part of your permanent income. They are urgent 2K. So those of you that receive urgent 2K, don't plan your income based on urgent 2K. Plan your income on your salary, something that is constant, that is permanent. So that is what this Milton is saying. So this is like a shade to urgent 2K people here. Let's continue.
So
Sorry
now,
for throwing jabs.
in addition, Milton Friedman actually, Ivan Fisher and my Modigliani life cycle hypothesis. You understand? It's just like it complements the two theories. Consumption should not depend on theory of consumer. That okay, it complements the theory of consumer. That is Friedman Milton. So now let's move on to Robert Hall and random walk hypothesis. So for Robert Hall, he extends Friedman walk. Sorry, just a minute. So for Robert Hall, he extended Friedman walk and proposed random walk hypothesis of consumption. He argued that if individuals are rational and markets are efficient, changes in consumption should be unpredictable and follow a random walk. Changes in consumption are unpredictable and depend only on new information. So he said this means that the best predictor of future consumption is current consumption. Hmm. For me, I did not agree with this particular guy. No, he said that consumption should should like changes. We should not be able to predict our consumption level. If you just wake up today and say, I'm going to consume this, you don't need to predict that tomorrow I'm going to consume this. But seriously, it's not realistic because you have to project. You have to think, okay, tomorrow this is what will happen. Today this is what will happen. So he's saying that whatever is happening yesterday should not affect what will happen today. That it should be unpredictable. Shouldn't be able to predict consumption, and consumption depends only on new information. Let's say now your own type of job. Let's say for instance, you said is a major market, and we said our current consumption is dependent on our current income according to Keynes. So let's say now, for instance, today you sell market very well. Tomorrow you do not sell market. The next day after tomorrow, you have a new information that if I carry my market to this particular place, I'm going to sell more. So what he's saying is that our consumption should be dependent on what happened today. Like now, what is going to happen that day that the consumption will happen? That is what consumption should be dependent on. That it should be dependent on on new information. So that is what he is saying, that we shouldn't be able to predict our consumption level. And um, the press, the best predictor for future consumption is current consumption. Like if I'm consuming so large today, it means I'm going to consume so large tomorrow. That is what he is saying. Or if I'm going to consume so less today, it means I'm going to consume so less tomorrow. Hmm. So this Robert Hall theorem, I don't really gbadun it, but it's still. But the basic thing I would like us to take home is just that consumption depends only on new information, according to Robert Hall.
Hello,
Can I
Funmi.
move? Okay, Perpetua.
Okay. Hi, Funmi. I want to say something. For this Robert, or a typical example will be child deck. Was it last
Yeah,
3 weeks? when they are doing this Chicken Republic refuel 1K, there was a
Yes,
massive
yes.
because of the new information now. People change their vendor of food and they're consuming more. People that don't eat normally in the office are now eating 3 plates of food because it's 1,000, which is equivalent to
Yes,
buying of 1 plate of food outside. So I
yes.
think this is just an example of Robert Hall random walk hypothesis. People tend to
Mhm.
buy things with the new information they get. For instance, also in the mall, when you see buy to get one free, because of the new
Yes,
information, people will also buy. And also this issue of fuel also when people perceive that there'll be an increase in fuel, they want to purchase more fuel and now before the price goes up. And also exchange rate, dollar exchange rate. People predict the dollar will rise. They will now hold the
the
dollar to beat the
what
inflation. I think yes, I think that is a typical example of this rubber. People act based on information, mostly
yes,
insider
people have
information.
better information. Yes, sometimes people also ask based on the panic in the market, the information that this is going to this is going to go up, but naturally that is not it. So they tend to buy more, and just to hold those things. Thank you, Perpetua. So let's move down to the last person, which is David Lamson and pool of instant gratification. So for David Lamson, he explained the concept of hyperbolic discounting and the pool of instant gratification. He explained the impact of psychological factors on consumption, particularly the concept of hyperbolic discounting, where individuals prefer immediate rewards over future ones. You all know what that means. I think we are all a victim of this. Like, we prefer immediate rewards over future ones. So let me give an instance. All banks are selling shares now, and when you say when you buy your shares in 1 year time, you are going to get this particular thing. Our bank is this, our bank is that. But people will be like, abeg, let me put my money inside business where I go see the reward now, 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 now. Rather than tucking my money somewhere, and I'm not even sure of what will even happen. So that is an example, and it also leads to time inconsistency preference and have implication on our savings behavior and self-control issues. So that is all for theory of consumption. So I would like to take it from the top again. Just one or two key points from what we've done tonight. One of two key points from what we've done tonight. So for Keynes theory, it said that current consumption is dependent on our current income. That is for Keynes theory. And we all know the consumption function, how it looks like. Our C is equal to A plus BY. And for Simon Kushner, he was trying to look at economic growth and income distribution, like income, reducing income inequality. So income distribution was trying to look at how income distribution promotes economic growth. So let's move down to our Ivan Fisher. Ivan Fisher said that the present consumption and the future consumption is based on their preference and interest rate. Like, we have to balance our present and future consumption based on our preference and interest rate. So that is what Ivan Fisher says. So now let's move down to who again. Who is that guy? So we have Franco Modigliani. He talks about individual plan their consumption and savings behavior over their lifetime. That is what Franco Modigliani says. And we have Mr. Friedman. Mr. Friedman states that our consumption decision is dependent on our permanent income. And we have Robert Hall states that um, our consumption is dependent on the new information. And Perpetua gave us a very good example. She gave us about 4 instances, which are very correct. So our consumption is affected by the new information we get. So then for David Lumsden says that he said consumption is dependent on our psychological factors. And we all know we have lots of psychological factors that could naturally affect consumption, especially in this era that we are in Nigeria. So we have a lot of things going on. Central banks are trying to, um, accumulate capital because of the CBN recapitalization, and people, the people's opinion about that actually matters. Are they going to buy shares or they are not going to buy shares? So it's just like that. So I think we've come to the end of theory of consumption. I would like us to go through our notes. Our note is actually very explanatory. And the textbook Kazim also talked about chapter 17 can read through. So there are so many instances and so many examples. Thank you very much, everyone.
All
Thank
right.
you
Thank
for